In 2015, Indian banks were sitting on a silent disaster. NPAs had soared 4 times in 7 years. Nearly 10 lakh crore of loans had stopped working. Projects were stalled. Corporates were drowning in debt. Public sector banks were quietly breaking. It was the largest banking cleanup operation in India's history. But this crisis did not begin with bad loans. It began with euphoria. Rewind to the early 2000s. India felt unstoppable. GDP was soaring. Infrastructure was booming. Factories were running 24/7. Optimism wasn't just a feeling. It was the currency. And credit was its printing press. Banks were handing out loans like candy. Not because projects were safe, but because growth itself felt guaranteed. And that belief built modern India. But it also planted a time bomb inside the banking system. Welcome to the India Brief. Today, in the finale of our banking series, we decode India's lost decade, how a party of irrational exuberance created the twin balance sheet crisis, and the massive cleanup operation that followed. Following the reform and strengthen approach of the two Narasimham committees in 1991 and 1998, the Indian banking sector felt bulletproof. They had higher capital requirement, asset cleanup was done, and global champions were created. Indian banks felt that bad loans were a thing of the past. The period from 2004 to 2008 saw aggressive lending to the power, infra and steel sectors. It was the building up of a new India. Until the global financial crisis hit in 2007-8. The global economy came to a standstill. Turns out, India wasn't bulletproof after all. Massive projects were put on hold. With projects stalled and cash flow visibility bleak, companies started defaulting on their payments. But the bank financials will not show that stress just yet. Banks started lending more to the same companies in order to enable them to meet their interest payments. This was zombie lending. A company that cannot pay back a 100 crore loan, no problem. The bank gives them a new loan of 120 crores to pay off the old one. On paper, the loan remains standard. In reality, the bank is just painting over a crack in the wall, while the foundation rots. This game of musical chairs continued till 2014. The argument, projects were delayed, not stopped. Eventually the projects will come around, cash flows will become regular again, and the loans will be repaid. The regulator agreed. Policies allowed the delay in declaring bad loans. The entire system was built on the promise of a better tomorrow. A tomorrow that did not come until it was too late. This regulatory forbearance and debt evergreening continued till 2014. And this wasn't just optimism. It was the way incentives were designed. In public sector banks, no one was rewarded for caution, and no one was punished for failure. Profits were private in reputation. Losses were public in recapitalization. This made reckless lending rational. The puzzle of the Indian economy was becoming more complex. Corporate balance sheets showed high debt. The balance sheets of the banks remained healthy, but only artificially. This led to the twin balance sheet problem, where stressed corporates and stressed banks trapped each other in a vicious cycle. By 2013, the denial was over. The economy was gasping. Entered the new RBI governor, Raghuram Rajan. He did not come to negotiate, he came to clean the house. His weapon of choice, the Asset Quality Review, AQR. The instruction was simple. Stop lying to yourselves. If it's a bad loan, mark it as a bad loan. By the time the AQR exercise was completed in 2018, banks had cumulatively reported over 11% in GNPAs. 1 in every 10 loans was bad. Governor Rajan expected this when he ordered the AQR. Swift moves were done and reforms implemented even before the NPAs were fully recognized. The Insolvency and Bankruptcy Code of 2016, commonly called the IBC, was the most prominent. Mega mergers were planned, and by 2019-20, 10 public sector banks were consolidated into 4 large entities. The goal was to create larger, stronger banks capable of funding the economic needs of the growing economy. Overall gross NPA showed a steady decline following the cleanup, led by IBC resolution, stringent provisioning, and prudent measures, reaching a historic low of sub 3% by 2025. But it wasn't just the bank assets that were bad. There was a larger systemic gap. A complete governance reform was required. And to do this, PJ Nayak Committee was appointed in 2014. The committee gave 3 major recommendations. First, repeal the Bank Nationalization Acts, which mandated 50% government ownership in public sector banks, and bring them under the Companies Act. Why? Corporate level governance brought corporate level accountability. Second, establishment of a Bank Boards Bureau for bringing in more professional directors on the boards of the public banking system. And third, and the most important one, split the post of CMD. This was the most crucial. Before this, the chairman of the board and the managing director were the same person. This led to a classic conflict where the CMD made the decisions as managing director and evaluated them as chairman of the board, concentrating too much power in a single executive. The committee recommended splitting the post to bring in decentralization and accountability. These ideas became policy under the Indradhanush Plan of 2015, the ABCDEFG reforms, covering appointments, board reform, capitalization, de-stressing, empowerment, accountability, and governance. While the big banks were being treated in the ICU, a different revolution was happening at the grassroots. The Nachiket More Committee appointed in 2014 asked a fundamental question. Do we even need banking with a one-size-fits-all approach? The answer was a resounding no. And this led to the birth of differentiated banking, which included small finance banks for the last mile and payment banks for the migrant workers. The SFBs were geared towards improving credit to small businesses and marginal farmers, and payment banks were positioned towards remittances. Other key differences were lending restrictions on payment banks, 75% PSL requirement for SMBs, and 75% SLR requirement for payment banks. To strengthen governance further, the Bank Boards Bureau was replaced by the Financial Services Institutions Bureau in 2022. This would recommend the appointments of MDs, CEOs, and executive directors to the Appointments Committee of the Cabinet, marking the formalization of a professional executive appointment system for the banks. By 2025, the cleanup was largely complete. NPAs had dropped to historic lows. Banks were profitable, capitalized, and far more professional. The twin balance sheet crisis was finally behind us. But this rescue came at a cost. Crores of taxpayer capital were injected to stabilize balance sheets. The crisis wasn't just financial, it became fiscal. And just as the banking system stabilized, a new disruption was already underway. Not from the RBI, not from the government, but from technology. UPI, CBDCs, and the fintech revolution. But that is a story for another dossier. India rebuilt its banks. But unless governance reform truly reshapes incentives, the next credit cycle could repeat the same story. And this time it will move faster. Because the real test of Indian banking is not technology. It is whether we have finally learned how to say no. No to bad loans, to poor underwriting, and to political pressure. This concludes our three-part saga on Indian banking. If you learned something new, share this with your network. Signing off, this is the India Brief.